The next topic we have is leverage. What is leverage? Let me explain the idea. Archimedes once said that if someone were to provide him a long, strong bar with a fulcrum, with some place to stand outside the Earth's surface, he could dislodge the Earth from its orbit. That's a scientific idea. Let me explain it in a more meaningful way that will help you understand. Let's say if you have to untie a screw or you have to loosen a screw and you have a small wrench of this size, for example, it will be very difficult for you to untie it. But the longer the wrench, the easier would it be for you to untie or just to loosen the grip of this nut, right? So the idea is that the farther you are from the pivot, less force is needed to give the rotation effect. Something similar is relevant for the business organization. Business can be leveraged. Business can be made more powerful by employing operational and financial leverage. The power of or the strength of generating more money. So what is leverage basically? Leverage is the relative amount of fixed cost in the firm's capital structure. If you have more fixed costs, you have used more machinery, plant, equipment, offices. That means you are large. So when the business is doing well, when the economy is doing well, you will make a lot of money. But the problem is when there is an economic downturn, sales fall, you lose big time. You have to pay rent, you have to pay insurance, you have to make lease payments, but the sales are falling, you will be in trouble. You would have experienced this during COVID-19. The big businesses were more in trouble because they had fixed costs to cover. Revenues are falling, sales were low, but they had to pay their fixed cost. Rent, insurance, taxes, and all that. So they were in big trouble. They had to lay their staff off. They had to make their employees redundant. So fixed cost is the greater the proportion of fixed costs in the firm's capital structure, the more leveraged the business is. There are two types of leverages we'll discuss in detail. One is the operational leverage, or called the operating leverage. This comes from holding plant, machinery, production processes. It will result in depreciation, insurance, and so on and so forth. Another is the financial leverage, and this arises because of having high levels of debt. Both, I won't say leverage is bad or good. It is dependent upon the circumstances. If the market is good, the economy is booming, leverage will make you very rich, very powerful, because you have the power this way to generate more returns than others. But if there is an economic downturn, the business are suffering, there is less economic activity, you will be the first to suffer because you have to pay fixed costs, you have to pay interest to the bankers or to the fund providers. So leverage could be very beneficial for the business in good times. It could be a trouble in bad times. Right? So let us just discuss through formulas, what does it mean? So a general statement for leverage could be, use this: degree of leverage is the prefixed cost income upon the post-fixed cost. Let me explain this idea. Let's say I earn $100,000 of sales revenue, and my variable cost is 40,000. I'm sure you know, sales minus variable cost gives you contribution. And sales minus variable cost minus fixed cost gives you operating profit. So let's say my sale is $100,000. My variable cost as given in the numerator is $40,000. And my fixed cost, let's say it is $50,000. Look what has happened. Your contribution, your prefixed cost was a nice, lovely number of $60,000. But after paying the fixed cost of 50, you are left with just $10,000. Look at this, what has happened. Your prefixed cost income before fixed cost was 60, but after paying fixed costs, you are left with just $10,000. All the profit has been taken away in paying the fixed costs. So you can say that this business is highly leveraged. So this is one of the formulas. You may not be using this formula in your questions or in the GLIME question bank. This is used in CFA and CPA. So it's basically sales minus variable cost upon sales minus variable cost minus fixed cost. This is a measure of degree of operating leverage where the fixed cost is involved. Write this down. Maybe you won't find this on your textbook, but somewhere maybe it will be helpful for you. The problem with this formula is that on your financial statements, you are not given variable costs and fixed costs separately. Your financial statements are based upon absorption costing, so you won't have such a nice division between variable cost and fixed cost. So what you will do, you may not be able to apply this formula on the financial statements because these numbers are not given separately for in the financial statement. So for this, we have an alternative version of the formula, degree of operating leverage, also called sometimes the operating leverage effect or just OLE. I told you variable costing financial statements are not publicly available. So you can't split the variable cost and fixed cost the way I have done in the previous formula. So you need to use the absorption basis numbers from your financial statements. Sales available from financial statements easily, from published financial statements, and earning before interest and taxes are also available. These are numbers easily available. Now let us try to interpret this in our way. Let's say my business has generated a sales revenue of $100,000. Okay, but after paying fixed cost, variable cost, I end up earning just $20,000 of EBIT, that is the earning before interest and tax. So the sale was $100,000, but EBIT is just 20. So basically the result is 5-1. So in order to earn $1 of EBIT, my sale revenue has to be 5. Compare it with business of Suhas. Let's say for Suhas, his sale is just $50,000, but his EBIT happens to be $30,000, let's say. Now, if you calculate this number for him, 50 by 30, see, he is in a better position. 1.67 to ratio 1. So for every $1.67 of sale generates for him $1 of EBIT. So for me, it means I have to pay a lot of fixed expenses. After paying off all of these, I'm left with just 20,000 only. But for him, things are quite good. So I can say that my business has more operating leverage, and for Suhas, his business has less operating leverage. So how do we interpret it in a wider context? If things are going well, there is more economic activity, my profitability will be much higher than Suhas because he has less operating leverage. But if there is an economic downturn, I will be incurring more losses than Suhas. That's the idea you need to remember. Leverage itself is a measure of risk. Business activity is good for you. If it is bad, you are done. Right? Okay, now, and why do we need sales and earning before interest and tax? There is a reason given in the textbook. It says that sales is a prefixed cost number. Sales is a prefixed cost number. Sales is just a revenue amount without any charge of fixed cost or any variable cost. And EBIT is a post-fixed cost. So somehow we have tried to apply this version of the formula. Prefixed cost, sales, post-fixed cost, EBIT. So to somewhat extent, this will still work. This is still work for you. It's fine. Now, there is another version of this formula where we use percentages. So what you see here, you see sales dollar divided by the earning before interest and tax dollars. This could be expressed in percentages form also. This could be used in percentages form. Percentage change in EBIT upon percentage change in sales. You can see that the numerator and denominator, they have been switched. Previously, sales were in the numerator. Now it's in denominator. EBIT now is in the numerator. Now, what this ratio tells me? How do we interpret this ratio? Let's say when we solve the numbers given, the percentage change in EBIT upon percentage change in sales, let's say the result is 7. You know what it means? It means 1% change in sales. 1% increase in sales causes your EBIT to go up by 7%. Things are good, they are very good. But when they are bad, they are very bad. When there is 1% decrease in sales, your EBIT falls by 7%. Right? That's the idea. For another business for which DOL in percentage basis is, let's say, just 2, for example. For this business, a 1% increase in sales causes increase in EBIT of 2%, and 1% decrease causes EBIT to fall by 2%. So it has less leverage, and this is highly leveraged. Leverage is good in good economic circumstances when the economy is doing well. But if there is an economic downturn, your business might face closure. So there's another important conclusion that we can draw. Please fix this in your head. A more leveraged firm like this one, the more sensitive operating income is to the changes in sales volume. 1% increase in sales causes 7% increase in your EBIT. And 1% decrease causes 7% decrease. So you are more sensitive to changes in your sales if you have more leverage. A business that has less leverage, see, its EBIT is not as much responsive to the changes in sales figure. Right? So this is the formula, these two versions you might use. Next, we have the degree of financial leverage. This is the second type of leverage, and it arises because of debt you employ in your business operations. Debt involves interest. So just like the previous version, pre-interest upon post-interest. Let me take you back. For operating leverage, it was pre-fixed cost income upon post-fixed cost income. This will help you calculate the degree of operating leverage. In case of degree of financial leverage, the idea is the same. Pre-interest income upon post-interest income. So you can call it pre-interest income is called the earning before interest and tax. And post-interest income, when you pay interest, it is called earning before tax. So EBIT is the earning before interest tax, pre-interest income. And when you pay interest, you get EBIT. So this is post-interest income. So let us try to interpret the idea. Let's say my business has an EBIT of 50,000. And after paying interest, Zohaib, I am left with just $1,000. Look at this ridiculous situation. 50,000 EBIT, but after payment of interest, of course, $49,000, I am left with just $1,000. So the degree of financial leverage is 50. Extremely leveraged business. Highly leveraged. Highly leveraged means in order to generate $1 of EBT, you have to generate $50 of EBT. Means massive amount is taken away by interest. Highly leveraged. Compare this to another business where the EBIT may be just $10,000, but after paying interest of 1,000, you have 9,000 earning after tax. So the business is much less leveraged than the one you see on the right side. So for this business, the degree of financial leverage is just 1.11. Right? So higher the number, the more financial leverage a business is. So just like in the previous version of the formula, we also have it in the percentage form. Please make sure you use EBT in the numerator. EBT upon EBIT. This is completely reverse to what we have just done. Numerator and denominator, they are switched. EBT now in the numerator, in EBIT in the denominator. And remember, percentage change. Now let me explain the idea. For a business, we calculated degree of financial leverage using percentages, and the result is 10. What does this tell us? It tells us if there is 1% increase in EBIT, it will cause 10% increase in earning before tax. Means your earning before tax or after interest income is much more responsive to EBT. For another business for whom this number is, let's say, 3 only, it would mean that every 1% increases in earning before interest and tax, your earning before tax or earning after interest will go up by 3%. So same idea applicable. Higher the number, the more leverage the business is, more responsive your EBT will be on the EBIT basis, and if the leverage is less, so it will be less responsive to change in EBIT. Now, I think we are done. Let us try a few questions to understand the concept here. Look at this. We have given a lot of data, and as I said, whenever you're given data, you must always look for what is required. The degree of financial leverage. Degree of financial leverage. All right. So what numbers are we looking for? Just this part of the arrangement. Degree of, let me clean this up first. Okay. Degree of financial leverage is equal to earning before interest and tax upon earning before tax. In other words, pre-interest income divided by the post-interest income. We just need these two numbers. So let us first find out the earning before interest and tax. We have this information here, sales. We don't need current assets or long-term. See, this is how you save time. If you read the questions requirement, you will know exactly what I need. I just need the numbers from income statement. If this asterisk sign is linked here, it says all sales are on credit. So this is totally irrelevant for my computation. So I just need numbers from this part only. Rest of the information is totally irrelevant for me. You save time. So sales 350. If you deduct cost of goods sold, this will give you gross profit. And interest expense, no. Income taxes, no. Dividends declared, no. Administrative expenses. So if you deduct CGS and administrative expenses, that will give you earning before interest and tax. So 350 less 160 less 67, it gives you 123. So earning before interest and tax is 123,000. But after paying interest, and this is the interest amount, if you deduct 3,000, you will have 120 in the denominator. Now you know for sure 123 is the earning before interest, pre-interest income. 120 is the after interest income, which you call the earning before tax. If you divide this 123 divided by 120, it gives you 1.025. And that's C. Next. For a firm with a degree of operating leverage 3.5, an increase in sales of 6%. So whenever the percentages are involved, we have another version of the formula. And I hope you will remember, degree of operating leverage is equal to percentage change in your income divided by percentage change in sales. Percentage change in income, because in the original version, sales upon income, but here we have the sales in the denominator and percentage income in the numerator. So a firm with a degree of operating leverage of 3.5, this is the number given here, an increase in 6% sales, which is in the denominator, will cause a pre-tax profit to raise by what? So this is something you need to establish, you need to find. So 3.5 is the degree of operating leverage, income upon in change in sales. So you need to find X, simply multiply 6 with 3.5 and you should get your answer. 3.5 multiplied by 6 gives you 21%. Now you can be sure what you found out. For a firm with a degree of operating leverage of 3.5, an increase in sales of 6% will increase the pre-tax profit by 21 as per the formula. And that's what we have just interpreted a little while ago. So that makes C to be the correct option. Next. This year, Nelson Industries increased earnings before interest and taxes by 17%, EBIT by 17%. During the same period, the net income after tax increased by 42%. The degree of financial leverage that existed during the year, we know the formula, just need to plug in the number. Degree of financial leverage on percentage basis is the percentage change in the earning before tax divided by the percentage change in the earning before interest and tax. You need to know your formulas. Now you just need to plug in the numbers and you will get your answer. So it says this year Nielsen Nelson Industries increased earnings before interest and taxes by 17%. That is your denominator. During the same period, net income after taxes increased by 42%. That's the numerator. So 42 by 17, you have to find degree of financial leverage. 42 by 17 gives us 2.47. And what it tells us, we got the answer, but what exactly it tells us? 1% increase in earning before interest and tax causes an increase of 2.47% in your earning after taxes. Right? So C is the answer. Okay. A summary of the income statement of Sahara Company is shown below. We have sales, we have cost of sales, we have operating expenses, we have interest expense and taxes. Based on the above information, Sahara degree of financial leverage. We cannot use percentages formula here because we have just been given the dollar-based numbers and we know what to do. Degree of financial leverage, in case you have given the dollar-based number, no percentages. What you're going to do, you're going to take your earning before interest and tax, which you call the earning before tax or interest or pre-interest income upon post-interest income, EBT. You just need these numbers and you get your answer. EBIT is sales minus cost of sales minus operating expenses before interest and taxes. That's what you call earning before interest and tax. So take 15 million less 9 million for CGS and 3 million for operating expenses. What you get is $3 million for EBT. And when you deduct interest of 0.8 million, you're left with 2.2. So this is earning before interest and tax, and this is earning after interest or earning before tax, but after interest. So if you divide 3 million with 2.2, what you get is 1.36, which matches with option B. See, you just need to know the formulas and you just plug in the numbers and you get your answer. B. Okay, a degree of operating leverage of 3 at 5,000 units means, since it's in percentages, so we know which formula to use. Degree of operating leverage is equal to percentage change in earning before interest and tax divided by percentage change in sales. That's the formula. Now let's plug in the numbers. So degree of operating leverage of 3. If the degree of operating leverage is 3, what it means without looking at the options given, it means a 1% increase in sales causes 1 times 3, 3% increase in EBIT. That's what we have just concluded. A 1% increase in sales causes 3% increase in earning before interest and tax. Now match the conclusion with these options. A 3% change in earning before interest and taxes will cause 3% change in sales. Wrong. 3% change in sales, not 3% change in sales, 1% change in sales. 1% change in sales will cause 3% change in earning before interest and tax. That's the correct option. If sale goes up by 1%, your EBIT goes up by 3%. If the sales fall by 1%, your EBIT falls by 3%. So that makes C to be the correct option. And I guess we have now the last question before we start our next unit. A financial analyst with Minerals Incorporated calculated the company's degree of financial leverage as 1.5. If income before interest increases by 5%, earnings to shareholders will increase by degree of financial leverage. In percentages terms, we know degree of financial leverage is equal to percentage change in earning before tax divided by percentage change in earning before interest and tax. Know your formulas, plug in the numbers and get your answer. Waqas says D. Degree of operating leverage is 1.5. It says if income before interest and tax increases by 5%, that is the denominator. So this will help you find the percentage change in EBT. So 5 times 1.5, that is 7.5. So what the conclusion is going to be, 1% increase in EBIT causes 7.5% increase in EBT. and 1% decrease in EBIT will cause 7.5% decrease in EBT. That's the conclusion. So now let's read the requirement. If income before interest increases by 5%, earnings to the shareholders will increase by 7.5%. So that makes D to be the correct option. I think I've just missed one important point. Not 1% causes 7.5. 1% causes 1.5% change. Let me just rephrase what I've just said so you don't get confused. Degree of financial leverage of 1.5. 1.5 means a 1% increase in EBIT causes 1.5% increase in EBT. Conversely speaking, 1% decrease in EBIT causes 1.5% decrease in EBT, right? So I might have just mixed things up. So that completes your unit 1 completely. Now we have our next unit on agenda, and this is your unit 2. Let me show you from the beginning.